Hi everyone. I wanted to make this video today moving on towards chapter 5 because I think we're all starting to get a really good grip on what our different debits and credits are, things like that. And I want to really get a good handle on looking at different expenses and revenues. And generally, whenever we are losing an asset, unless we're paying off a debt, it's going to be an expense, because if we're giving up an asset and we're not paying off a debt or getting an asset in return, that's an expense. So I want to look more closely at different sorts of transactions where we are paying expenses. And I want to look at a few different revenues that we can get, things like that. But more importantly than that, I want to look at how we actually put these into our general journal, which is the next step in our accounting process. So let's look at the slide. Looking at our general journal and our general ledger today, we've already kind of touched on the idea of our general ledger and you've seen a bit of it, but we're going to look at it in more detail. So we're familiar with our debits and credits, and we're familiar with how that balances with our accounting equation. So remember our accounting process. We've got our source documents, and then we journal it. That's what we're looking at today, because that leads to our general ledger and what we call our trial balance. We add up the value of all of our accounts, making sure that our debits and credits are still equal. Now, the general journal is used to record all of our day-to-day transactions. Everything that we do will be recorded in here. Its main purpose is to record debits and credits, and it shows us which ledger accounts it's going to based on the details of our business documents. This follows the rules of double entry, and it's a good way to kind of reinforce it. So let's begin by looking at the sort of entries that we'll see at the commencement of a business. So you'll see here that we have a deposit by the owner of $80,000 in cash. So that's actually provided all of our detail that we need. So we've got the date that the transaction actually occurred. Okay, so we have the accounts that are being affected, and it says, you can see, cash at bank is being affected, and a debit of $80,000 is going into it. The other account is capital, and a credit of $80,000 is going into it. So this says the names of the accounts that are impacted, and it also gives a brief detail in what we call our narration. Okay. It also shows our debits and credits, as I said. So we can see the two columns are associated with both sides of our accounting equation and follow the rules of double entry. And as I said, we have our narration, which is the last item. Underneath the accounts, we give a really short description, and this is one of those things that's really important for the exam, and good narrations are always going to add marks. Now, when we're posting to the general ledger, we go transaction by transaction, just adding all the time. So let's look at this. We can see that we've still got our entry on March 1st, where we deposited cash to commence the business. But now you can see we've received $20,000 more, so our cash at bank has increased by another $20,000 by a loan from United Bank. So our description of this is we borrowed $20,000 from United Bank. Now, once we have put these entries into our general journal, this is where we put them into our general ledger. And let's look at how this is transferred across. So we're going to look at our cash at bank, which is obviously our asset account. And you can see we've put in our March 1 entry, where $80,000 was debited into the account. Okay, and here's our capital account where you can see we've credited $80,000, and you can see that we have our balance. The reason we do these entries is because the cross-reference is really important for us to be able to trace the details of each transaction. So if we're cross-referencing the wrong account, we might think that we're paying wages when in fact we're paying a bill. Or we might think that we're receiving a loan where in fact it's money from the owner. So we need to make sure that these cross-references are always correct. Now let's look at that second transaction where we received $20,000 as a loan. So the other half of this transaction is obviously the loan account because we received a loan. So our liabilities have increased, as you can see. Now, we already know that GST is going to impact a lot of transactions, and that needs to be recorded as well. So let's look at what happens when we sell goods for cash. So we'll often collect GST when we do sell goods. When we pay expenses, GST is paid, which reduces our liability. When we buy an asset, we often reduce our GST liability by paying GST. And there's a lot of other transactions. So at this as I said, at this point in the year, we only cover two main transactions. So that's going to be buying assets and things like that, and paying expenses, and also on sales. So let's look at these two. So we bought a computer for $2,000 plus $200 GST. And we've also paid $1,000 of advertising, which is our expense, plus $100 GST. So you can see we've increased our asset account of computer by $2,000. We've decreased our GST liability by $200. And our cash at bank, because we've paid cash, has been reduced by $2,200. Advertising expense is very similar in that we have increased our expense account because we've paid $1,000. We've reduced our GST liability by $100, and we've decreased our cash at bank by $1,100. When we post these to the general ledger, they'd look like this. So we'll first do our cash at bank, the credits. Now you can see that our cross-reference, obviously we've got to cross-reference two different accounts because we've purchased an asset or we've paid an expense, depending on which one you're looking at, and we've also paid off some GST. So we've got two cross-references. We've got computer and GST clearing, advertising and GST clearing. When we look at the debit accounts, we'd have computer, we'd have advertising, and we'd have these two movements in GST clearing as well. So you can see once again, you put it all together, it's still going to balance. Now, as we continue through our reporting period, we'll obviously continue to record our transactions within our general journal. So this gathers all of our information for every single event that takes place within the business, and puts it all into sorted accounts, which is our ledger accounts. So you can see the bank account so far showed two cash receipts, which was our capital and our loan, but we also showed cash going out, which was when we paid for advertising and the computer. So when we put it all together, it would look like this. And it's going to build up over the month. And at the end of this month, we would balance it. So obviously our debit side adds up to $100,000 and our credit side totals $3,300, which means there was $100,000 sitting in that account, but we've withdrawn $3,300 from it. So this is going to show how we balance an asset account, or a liability account for that matter. It's the same process. So much like we balance a balance sheet, we put the largest figure down, and then we have to add in this missing figure, which would make the credit side balance. Now, I'm sure that by now you will have figured out the missing figure is going to be $96,700 because you're minusing one figure away from the other. And you entered this as a balance. So it will end up looking much like this. Okay? Now, again, we have to enter in $96,700 on both sides because this is double entry. We put an entry on both sides. But you do need to keep in mind that normally we don't balance accounts until the very end of the period. So the fact that we're doing it on March 4th is just a bit of an anomaly to show you how we do it. And we're going to practice this a lot. So we'll be putting up example liability accounts, example owner's equity accounts, example asset accounts, and we'll be balancing all of them because these three accounts, which have values that will carry on into the next period, we always have to balance these. Then, once we have all our accounts balanced, at the end of the period, we then put together a trial balance. So, if it balances, it doesn't necessarily mean that it's perfect. It just means that your debits are going to equal your credits. You may have done something wrong, such as putting one expense into a different expense account. So wages into telephone bill or something like that. So it's not going to always account for those sorts of errors, but it's a good start as a bit of a check. So looking at the trial balance from all the entries that we put in so far, you can see that we've got the cash at bank balance of $96,700. You've got the computer account, the advertising, the GST, and you've also got your capital of $80,000 and the United loan. Both sides add up to $100,000, so that's balancing. Now, you might be asking what we do in terms of revenue and expense accounts. At the end of the period, we don't balance those. So far you're looking at advertising and you're thinking to yourself, wait, we haven't balanced that. And we haven't even balanced our computer account. If this was a real scenario, what we would do is we would do a balancing entry for all of our assets, all of our liabilities, and all of our owner's equity accounts. But this is just an example, and because these amounts haven't changed, we don't really need to do one to fulfill the example of the trial balance. As for the revenue and expense accounts, we'll be looking at the process that we do for that, which is called closing off an account. But that's not something that I want you guys to worry about for this chapter. For now, I want you to use the journals and the ledger accounts to continue to develop strength in recognizing your debits and your credits. I think that once you go through this chapter and you kind of see the journal as the event that's happening, which means we're putting in instructions for ourselves, I think it'll become a lot clearer. As I said, I want you to continue working through chapter 4, chapter 5, and use this as kind of the next step. I think this will really help solidify the idea of debits and credits for some of you. And yeah, just keep in mind that when you're looking for revenues and expenses, basically, if we're paying out something or we're losing an asset and it's not to get a different asset, it's not to pay off a debt, it's probably an expense. If we're receiving money or we're receiving something and it's not increasing a liability, it's probably a revenue. Okay? So, in terms of wrapping this up, I want you to go through and I want you to make notes from this slideshow. It's really important that you have these examples written down. Being able to see how we go from general journal to ledger to trial balance is going to be really vital. In terms of the questions that I want you guys to do, I'm not putting up a set list of questions because I think that they're all going to be pretty vital to us this time around. So keep working on all that. Realistically, I think being tomorrow and the double, I think that we should probably be moving on to chapter 5. I'll also be going through the ethics question with you. So with that in mind, thanks so much for putting up with me over the last few days. I know that I've been a little bit all over the place, but you guys have done really well in supporting me and supporting each other in the class. I will leave you guys with Ren's meme, and I will see you guys in class. Thanks. Bye.